All right, let's talk about how to pay for dentures when Medicare won't. So as you already know, dentures can be really expensive. And according to GoodRx, a double arch denture could cost between $3,000 to $7,000. A full mouth tooth extraction could cost $6,000 to $16,000. And then other services provided during the time of getting dentures could be $1,000 or more. So realistically, your first set of dentures could cost you between $10,000 to $25,000. And that's just a lot of money for people in retirement. So the question then is, how are you going to pay for your dentures? So Medicare does not cover dentures. There's some Medicare Advantage plans that may pay for a small portion of them, but generally Medicare has no coverage towards dentures. So that leaves you with paying cash, so you could pull money out of your savings or retirement accounts, or another option, assuming you didn't want to pay cash, is to get a Care credit card and finance them, and that's assuming that you qualify. Now, let's assume that you didn't want to pay cash and you wanted to finance them with a Care credit card. Assuming that your initial set of dentures was going to cost you $18,000, the Care credit card, the minimum payment that you would have would be $486 a month. For some of you, that may not be a big deal. For others, that could be crushing a debt payment to make every month. But here's the good news. There is an alternative to paying cash and using a Care credit card. So let's take a look at the scenario of Steve, who is 63, desperately needs dentures. He's got all sort of dental problems going on right now. He's got an income of $1,900 a month. He owns his $400,000 home free and clear, and he's got about $25,000 in retirement savings. Steve could afford the payment on the Care credit card, but it would be tight financially for him to make that payment every month. And he does not want to pull a bunch of money out of his retirement savings because he knows he's going to have other large expenses at some point in the future during his retirement, whether that's car repairs, home repairs and maintenance, or health care costs. So what should Steve do? Should he just finance them anyways, or is there something better? Well, I think that this could be a great alternative to either paying cash or using the credit card, and Steve thought so as well. So Steve decided to give me a call to find out about getting a reverse mortgage. And this bar chart represents Steve's reverse mortgage. The blue represents his home value, and we can see that's increasing over time, assuming a 4% appreciation rate. The orange represents his loan balance. So initially, Steve is going to draw out $18,000 to pay for his dentures, and he's going to lump in the closing costs into the loan. And we can see this loan balance is increasing over time. And the reason that loan balance is increasing over time is because we are making the assumption that Steve is not going to make a monthly mortgage payment towards the reverse mortgage. He still has to pay his property taxes and his homeowner's insurance, but because he's not making a payment, the interest and mortgage insurance just gets added to his loan balance over time, and therefore his loan balance is going to increase over time. The green represents his line of credit, and initially he's starting off with a $96,000 credit or line of credit, and that's because beyond taking out the funds for his dentures and lumping in the closing costs, Steve is left over with $96,000, which for Steve is fantastic because that's 4 times what he even has in his savings account today. So the great news is that the funds in the line of credit, as you can see, are also growing. And the reason the funds in the line of credit are growing is because any funds available grow at the current interest rate plus 0.5%. So if Steve never needed to dip into this line of credit, in 15 years, he's expected to have $281,000 line of credit that he could draw from if needed. The other great thing about this is that if Steve needed money out of this line of credit at any time, he can draw those funds out, and he still does not have to make a monthly payment towards his reverse mortgage. He still has to pay his property taxes and his homeowner's insurance, but drawing funds from the line of credit does not require a monthly payment. Now, Steve didn't really like this idea of this growing loan balance, and so Steve thought, well, I'd be making a payment if I financed my dentures in any other way. Why not just make a payment towards the reverse mortgage balance? And that's what Steve decided to do. What Steve felt comfortable with is making a $350 a month mortgage payment towards the reverse mortgage. So we can see the loan balance, we're actually paying this down over time. And in 15 years, Steve basically has this loan paid off, which is pretty cool. But something else pretty magical has happened, and that is his line of credit has increased significantly. So in 10 years, by making a $350 a month payment, Steve is expected to have $258,000, whereas compared to not making a payment, Steve would only have $196,000 in 10 years. So by making that monthly payment, Steve has added $62,000 to that line of credit over 10 years. The reason that's happening is because dollar for dollar, whatever Steve pays towards the reverse mortgage balance not only pays the loan balance down, but it increases the line of credit dollar for dollar. So again, a drastic impact by just making that payment. So by using the reverse mortgage, Steve gets the dentures that he wants and needs. He doesn't have to take on any new monthly payments with any other financing source, whether that's the Care credit card, a personal loan, another credit card. He's not taking on those monthly debt payments. By getting the reverse mortgage, it creates a ton of financial flexibility in his monthly mortgage payment. Because Steve doesn't have to make a payment, he could pay as much or as little as he wants. He could make payments for 6 months and then stop. It just gives him a lot of flexibility that any other type of financing solution for his dentures doesn't provide. And he still has to pay his property taxes and insurance with the reverse mortgage. It creates an additional source of funds to deal with other large expenses during his retirement. So again, we know that Steve was only starting off with $25,000, and by getting the reverse mortgage, he was actually able to access another $96,000. And again, he can use those funds to pay for car repairs or home maintenance or healthcare costs at some point in the future. And if he makes monthly mortgage payments, he has access to all those payments at any point in the future, which is awesome. And that's assuming that he's meeting his loan obligations. And the primary loan obligations with a reverse mortgage are this. You got to live in the home as your primary residence. You have to pay your property taxes and your homeowner's insurance. You have to pay any other property expenses such as a homeowners association or utilities, things like that. And you've got to maintain the property. And those are all things that Steve is already doing and would continue to do into the future. So you want to see how this would work for you? Give me a call. Happy to speak with you, answer any questions that you have about the reverse mortgage. Run your numbers. We can do forecasting, see what it would look like if you made or didn't make monthly mortgage payments towards the reverse mortgage. Happy to help in any way that I can and answer any of your questions. I look forward to speaking with you. Thanks.